Our third presenter today is Haruki Toyama. Haruki is a co-founder and president of Marcus Asset Management and serves as the portfolio manager for its assets. Prior to his work at Marcus, Haruki was a portfolio manager and analyst at MFS Investment Management, David L. Babson and Company, Madison Investment Advisors, and Toyama Capital Management. He received his MBA with distinction from Cornell University's Johnson Graduate School, where he was awarded the prestigious Freed Fellowship. Haruki has a BA from Brown University with a dual concentration in music theory and economics. Perfect. He's actively involved in the community, serves on the board of the Milwaukee Symphony, and lives just outside of Milwaukee with his wife and two daughters. Please help me welcome Haruki Toyama.
Thank you, Joe, for that introduction. Well, Chip talked about a company with an unassailable competitive advantage that stems from physical assets. I'm going to talk about a company whose advantage stems from having no physical assets, so we'll talk about that. But first, let me go through some of the slides here I need to get through. Okay, so disclaimer, this is just my opinion. I could be wrong. I could change my mind at any time. Please do your own research. Okay. So a quick introduction about us as a firm, because I think it's important for you to look at, when I talk about the stock, look at how we approach it, how we think about it, how we got to that point where we own this particular stock. But our company really has two foundational pillars. One is that we believe in extreme alignment of interest between the clients and us. And it's easy for us to say because we're a family office-backed company, and so we manage our clients' assets in virtually the exact same manner in which we manage our own money. And then on the investment side, we have another extreme approach, which is that we have a very, very private owner mentality. So what does that mean? That means the first point, which is that we view a stock as a piece of business, not a piece of paper. We don't really look at it as a quote on a screen. It's not something we buy because we want to sell tomorrow, next week, next month. We buy something because we want it to last a long time. We hope to be owners. We hope to earn the profits out of that business. And that's how we want to make money, not because we want to sell to someone else that's willing to pay a higher price down the road. So what does that mean? That basically usually means that we tend to ignore Wall Street. Wall Street is a very transactional place. They want the mood swings. They want you to get excited. They want you to feel good or bad on a given day, make a lot of transactions. We hope to make money because the company does well, and we bought it cheaply, right? And because we have that private owner mentality, we conduct extensive research. And so our portfolios, we basically have two primary characteristics of our portfolios. One is that it's very concentrated. We tend to own 10 to 20 companies. And because we have a threshold which we need to clear, we like to say that we like to own great businesses at average prices and above average companies at below average prices. So the one I'm going to talk about today is TGS. This we think is a wonderful business trading at a well below average price. So what does TGS do? It's a Norwegian company. It actually trades in Oslo. And the stock price right now is about 210 krona. There's about 6 Norwegian kroner per dollar, so it's about $36 per share. Market cap of $3.7 billion. So it's a pretty sizable company. What we like about it, here's a quick summary, bullet points. I'll go through each one in more in depth later. But number one, it has great growth prospects, we think. What's really unique, it has a very asset-light business model, which I'll go into in more depth. And because of that asset-light model, it's highly profitable. You see some of the numbers here. I'll show you some more later. But it's very cash flow generative. $36 stock price, $4 net in cash per share, and you see the multiple there, and I rounded up a little bit. It's actually a little bit cheaper than that, but 11 times PE, and you know what the market's trading at these days is 14, 15, 16 times. But here's a quick description. So what is seismic data? Seismic data is an underground map of the geology underground, and this is what oil and gas companies use to decide where they want to drill. No one actually spends millions, tens of millions, hundreds of millions of dollars drilling a hole in the ground without buying seismic data first, right? If you're going to drive to Cincinnati tomorrow, you're going to look up Google Maps, whatever the case is. You're not going to drive blind and drive out of your driveway without looking. So seismic data is gathered in the ocean at least. Land is different, but in the ocean where TGS mainly operates, these big boats shoot, and this, I'll show you the next slide here. There's an air gun that these boats stick in the water. It shoots seismic shock waves down to the ground, and as they bounce back, that data is collected by these large streamers that can last for hundreds and hundreds of yards, miles, potentially, behind the boat. And with that, you can draw an underground map. This is a 2D slice of a region in the Atlantic. Now, The scale is a little deceptive. Those red lines that you see are probably several hundred feet in height. So we're talking about a large map of miles and miles into the ground, right? And with this, you can look for places where you think oil and gas will pool, and that's how you kind of decide, and there's an expertise to this. You don't just look at it and go, oh, there's an anticline. That bump is called an anticline. You don't just say that you want to build there or drill there. You do other kinds of sampling, core sampling, and other kinds of research. And you can also use this data to decide how you want to drill and how to physically extract the oil once you have the well. So this is seismic data in combination with reservoir mapping. You can see the heat mapping. It tells you how the oil may or may not flow. So oil and gas companies can use this after they drill the well as well, but the vast majority is used to decide where to explore. So what kind of growth does this company have? Well, the oil and gas industry is very boom and bust, as you know, but the capital expenditures has grown probably 5 to 10% a year now for past 10, 20 years. So this shows you the annual growth rate. It's very volatile. It was negative 10, 15 years ago, turned highly positive. It's probably going to grow 5 to 10% in the future as well, somewhat dependent on oil prices, which we can talk about later. Seismic data demand itself grows about in line. It tends to grow at a slight premium, and the reason is that oil and gas is getting harder and harder to find. Right, so what that means is that people are now talking about drilling by Greenland, in the Arctic, off the shore of Brazil. And if you go to Brazil, they have a very large pre-salt deposit, and that means the water is a mile deep. Then there's another mile deep layer of rock. There's another mile deep layer of salt, and then below that is where the oil is. So you need very, very complicated, high-tech seismic mapping to try to figure out where to drill, and that's more expensive. And so the unit demand and the revenue demand for seismic data grows several points faster than the market overall. And so TGS is very, very good at that. So this is TGS itself. Historically, this is a 10-year chart here. Revenues have grown 22%. The vast majority of that organically. Profits have grown 22%. So it's very good performance. That's not going to continue in the future. It's a much bigger company than it was 10 years ago, but I think they can do something double-digit or more. So what is this unique asset-light business model? Well, that big boat I showed you earlier that costs about 150 to 200 million all in with the equipment, takes about 40 or 50 people to crew. Well, TGS doesn't own any of that. They don't employ the crew, they don't own the boats, they actually subcontract all that out. It's unique. It's the only marine seismic company that does that. All 10 to 20 other competitors own a huge fleet of boats that have a lot of assets sitting there, and when the market downturns, guess what? They're stuck with boats and crew, and they lose a lot of money. And TGS actually subcontracts all that out. Now, they also have something called a multi-client data survey. Their revenue model is a multi-client. I'll talk about that in a little bit. But what's the advantage of this model? I mentioned a couple of them, but to the customer, multi-client is cheaper. So if I'm ExxonMobil, I can go out and spend $50 million and contract with a seismic company that has a fleet of boats, and it will acquire the data for me. And then if I give them the $50 million, I own the data, right? But I can also have multi-client purchases where I create a consortium with Chevron and Conoco and Devon and so on, and I pay $5 million instead of 50, because 50 sounds pretty expensive to me. So I only want to pay $3 million or $5 million. So I create a consortium, we all pitch in a little bit of money, and the seismic company retains the rights to that data. And I don't particularly care because I'm going to own the data temporarily, I'll know I want to drill, and then I let it go. Okay? So TGS does all multi-client. So they own all the data. They have a data library on the balance sheet that they have valued at $650 million. I think it's worth a lot more. But the point is they own it, and what that means, the advantage of TGS, they can resell that data as many times as they want. And so over the lifetime of that library, they tend to get about 2 to 3 times more revenue than they would have for that unit of data if they had sold it on an exclusive basis to Exxon. Okay, so that of course results in very high margins. And as I said before, they don't own the boats, they don't employ the crew, so the returns on capital are tremendous. Right, so these are industry operating margins. I put a bunch of public competitors out there to TGS. These are all asset-based competitors, so they own the vessels. You see it's boom and bust. Right, back in the oil and gas industry downturn in 01, 02, 03, most of them lost money. They made a lot of money in 06, 07, and then in the last downturn, a bunch of them lost money, and most of them had their margins shrink by half or more. Here's TGS, right? Much, much smoother and much higher. So in a bad year, their margins are 30%. In a good year, they're 50%. They average 40%. And that, of course, translates to better returns on capital. That red bar is TGS. Their 10-year average is 30% plus returns. That yellow bar next to it is the average industry returns on capital, excluding TGS. And the brown ones are some select individual competitors I highlighted just to show you the returns. But TGS has by far the best returns in the business. So what do you pay for something like that? Well, I'm not completely sure, but there's some analogies, right? TGS is unique in its industry, so there's no comparable I can look at and say, this is what I think it's worth, this is what other people think it's worth and are willing to pay. So this is a trucking industry. Most trucking companies own a fleet of trucks and employ their drivers, right? There's a company called C.H. Robinson that's basically a broker. So if you go to C.H. Robinson and you want to ship something from point A to point B, they don't use their own trucks, they hire all that out. And so that's that red bar. C.H. Robinson is a very profitable, high-growth company trading at a 20 times PE. That yellow bar is everybody else, the average, and the brown bars are individual companies. You see they get a premium, and rightfully so. Their returns are higher, margins are higher, they grow higher. So they get 20 times, everyone else gets 15. Here's another analogy. The air and ocean freight industry. Same thing here. The brown bars are individual freight companies that happen to own a huge fleet of boats or planes, so it costs a lot of money to own these, and they get very low multiples, typically 10, 11, maybe 12 times. There's FedEx in the middle. They deserve a premium, 15, 16, it's a great brand. But you see here the average is 10 times. Expeditors, which is an asset-light freight forwarding company, consistently gets a multiple 20 times. Its growth is higher, its returns are better, it's a much more high cash generating company. So here's TGS. TGS is that red bar on the very left. They're getting a 10, 11 times. You back out the $4 a share in cash, they're getting a 10, maybe 11 times PE multiple. But everybody else is higher. Right? So why is that? To be honest, I don't completely know. I don't think this is the way it should be. I think people will figure it out. But here's some bullet points just to say, well, I think this is why it's happening. It's kind of a misfit. It's a Norwegian company. It's headquartered in a suburb of Oslo. The stock trades in Oslo, right? But it reports its financials in US dollars. Its CEO is American, lives in Houston. Their biggest office is in Houston. The majority of their business is actually Gulf of Mexico. And so they have most of their employees in Houston. So it's kind of living in this in-between world from a corporate standpoint. And so when I talk to most oil and gas analysts in the US, they've never heard of TGS, right? Oil and gas people, when you say seismic to them, they think of these companies that own these fleets of boats, $150, $200 million boats. And they don't like the business, it's an asset-heavy business. They don't understand TGS, right? So I think this is the opportunity that we have, is that people still misunderstand the business. It's got a wonderful track record. The management is great. They pay out a 4% dividend. They're willing to repurchase shares when the stock is cheap. So you can have all this great cash flow returned to you in an intelligent manner. They don't make a lot of M&A acquisitions and dilutive acquisitions of stock options. So I think you'll see this value returned to you. Personally, whether or not the market recognizes it, I'd be very happy owning it. But I think it's going to get a much higher multiple in the next few years. And the final point I just want to note is a risk. This is obviously not riskless in any way, but there's an industry issue, and obviously it's tied to oil and gas prices to some extent, right? I like it because even if oil prices come down, these companies will continue to generate a lot of cash. That makes me very comfortable knowing that it's not part of the boom and bust of the industry. But they also had 50% earnings and revenue growth last year, so I think we might see a period here where earnings are a little flat. I think most projections are that they'll grow 5, 10, 15%, but they could easily do flat, especially if oil prices continue to come down a little bit. But that's my idea, and if you want to have any questions, please feel free to come up to me afterwards.